There are two important tax exemptions that anyone can utilize. The estate tax exemption allows a certain value of assets to be exempt from estate taxes which are imposed upon one's death. If someone transfers assets while living, the gift tax exemption allows a certain value of those assets to be exempt from taxes which are imposed upon the transfer. Establishing a gifting trust offers a way to remove assets from your taxable estate at death, and thus avoid an estate tax on those transferred assets. It also removes any future appreciation of those transferred assets from your taxable estate. A gifting trust is an irrevocable trust created during life and funded by one person, often one spouse, for the benefit of others, often the other spouse, and/or their descendants. You can transfer a variety of assets to a gifting trust, including cash, marketable securities, a business, a life insurance policy, and real estate. Growth assets, or assets with good cash flow, make the best gifts due to the likelihood of post-gift appreciation or income accumulation. A gifting trust can be designed to be a grantor trust, in which, for estate tax purposes, the grantor relinquishes control over the assets transferred to the trust, but still retains all the income tax liability for those transferred assets. Therefore, the trust's income is reported on the grantor's personal income tax return. The income tax paid by the grantor on the trust's income serves to decrease the grantor's taxable estate, while at the same time increase the grantor trust's assets, free from future estate taxes. Although the grantor has technically removed assets from their taxable estate, the grantor's spouse, and other trust beneficiaries, if any, have access to the income and principal. There can be significant estate tax savings achieved by transferring assets to a gifting trust. By doing this, the post-gift appreciation of assets within the grantor trust increases the value of the grantor trust, without additional gift or estate tax being imposed. A gift tax exemption is also available to each individual, for an amount which varies year to year. This exemption allows a person to gift up to a certain dollar amount without paying a gift tax. In addition to this gift tax exemption, the 40% estate tax that would have been imposed on these transferred assets will be avoided, since they are no longer part of the transferor's taxable estate. When assets are transferred to the gifting trust, a valuation discount may be applicable, which further reduces the transferred asset's value for gift tax purposes. By creating a gifting trust, paying the initial gift tax, or utilizing the tax exemption, and retaining liability for any subsequent income tax of the trust's assets, it provides the opportunity to further decrease your taxable estate, while simultaneously increasing the value of the assets within the trust, without further taxes imposed on those assets at your death. With our complimentary estate planning consultation, you can discuss alterations you wish to make to an existing trust, or create a new one as part of your estate plan. Go to nicilawfirm.com or call 239-449-6150 to schedule your free consultation with James Nici, a Florida board-certified attorney in wills, trusts and estates.